I'm John Dunleavy with Monorail, and we're going to talk about how to get started investing with ETFs. The Vanguard approach really is the most simple approach because it uses ETFs, which stands for Exchange Traded Funds, which really are a more sophisticated version of a mutual fund, which has been around for decades. The difference is ETFs generally are more tax efficient, and obviously none of us want to pay more taxes than we have to pay. And the problem with mutual funds can be that every time there's a transaction, people buy into a mutual fund or sell out of a mutual fund in a taxable account that is a non-retirement account, a capital gain occurs, which could be a gain or a loss. There can be a period of time where the market's down and yet the portfolio manager's trading, creating gains, which is a double whammy, meaning you have to pay taxes when you lost money on your investment portfolio that year. Getting back to ETFs, ETFs are more tax efficient than mutual funds. They have the same kind of principle as a mutual fund, that is broad diversification. The founder of Vanguard said, you don't have to pick a needle in a haystack when you buy an ETF, what we call sector ETF, which is a broad area of the market. You're buying the entire haystack rather than the needle. There are a whole variety of different types of ETFs. Sector ETFs, which are more passive, like a bond index or a stock index fund. They're buy and hold type. A lot of them are based on the S&P 500 and really replicating that. Others are more active. Some of them are even levered ETFs so that returns are magnified. Generally, most conservative investors won't want to play in levered ETFs. They generally stick to the passive sector ETFs, which are more tax efficient because they have minimal trades. And the big difference also between mutual funds and ETFs are every time someone comes in or out of an ETF, it's more like purchasing a stock. That is, you have your own individual basis, what's called a basis or your cost, which minimizes capital gains. You only have a capital gain on an ETF, a passive ETF, when you sell. It's like owning a stock in that sense. It's much more tax efficient. There's another difference we can mention between mutual funds and ETFs are the way that you can get in and out. When you own a mutual fund and you want to buy or sell, the transaction doesn't happen until the next day. ETFs trade on exchanges like stocks, so you can do intraday trading and basically know what your execution level is going to be, whereas you don't know until the next day when you trade on a mutual fund. So it's much more like a stock, and that's why it's been a rapidly growing part of the market. But on the other hand, like I said, active ETFs can have less tax efficiency because there's more transactions happening, with portfolios turning over more rapidly, and consequently, they're not as tax efficient as buy and hold or passive ETFs. This is John Dunleavy. Thanks very much for watching, and we hope to see you again on the next video.